Hey everyone, welcome back to Signal or Noise, episode 4. I'm Charlie Bilello, joined as always by Peter Mallouk. Peter, a lot going on in the markets. There's a little bit of exuberance out there. I don't know if you've noticed, but this feels a lot like the exuberance of times in the past. Not that long ago, we had this exuberance, and I'm kind of surprised it's back again. But it's Irrational Exuberance AI edition. Do you remember Alan Greenspan's speech back in December 1996 on Irrational Exuberance? Bring back any memories for you?
Oh, yes, I do. I think become a textbook speech at this point.
Yeah, and the thing I remember most about it is that the market kept going up thereafter.
Right.
And
That's right.
two things that the Fed didn't start hiking interest rates then to try to break that exuberance, and then the market would go up in 97, 1998, 1999. Didn't peak until March 2000. But here we are today, AI edition. Anything related to AI, we heard it all during earnings season. Anything related to AI just received this bump higher. And so, of course, every company's talking about how they're incorporating it into their business. And no company seems to have captivated the attention of investors more than Nvidia, right? So the supplier, interesting that the supplier of this boom, this revolution, which no doubt is going to be real, there's going to be a huge impact. The supplier of this, Nvidia, seems to have captivated the attention of investors more than anything else and has become now a $1 trillion company, joining the likes of Apple, Microsoft, Google, and Amazon. And Peter, you tweeted this out as well as I did. What stands out in this chart here in terms of Nvidia versus those other big four?
Well, I think the profitability, for one, even expected profitability. I think to your point about AI, I mean, a lot of people confuse is something going to be real versus what is going to prevail. So we saw that with the .com deal. You know, everyone on their investor calls now is finding a way to incorporate the language of AI into the call to get that stock bump and to look like an AI company. And you saw that with all of the companies adding .com to their name or trying to really tie themselves to the internet. Well, the internet can work out and have a lot of the .com companies not work out. And I think we see the same thing with Tesla. I believe every car is going to be electric eventually, and then not to the too distant future. And not only that, but they might even be driverless, and all of them in the not too distant future. But that doesn't mean that Tesla is going to dominate the space in perpetuity the way the stock price looked, about a year ago. And I think that's where we are with AI right now. I would like it to cryptocurrencies. Is a cryptocurrency going to prevail? Yeah, I think it will. Is the one that every specific person likes the one that's going to still exist? Not so sure, right? And so I think we're seeing that here with AI. We're seeing NVIDIA is the clear leader in this space. They've been described as the arms
Yeah.
dealer to all sides in
Yeah.
this war. AI is going to
90%
revolutionize
market
everything.
share, right?
Yeah,
90%
90%
market share.
market
Yeah.
share. It's going to revolutionize, AI is going to revolutionize everything, I think, beyond all of our wildest expectations. But capitalism begets competition. They won't have 90% market share a few years down the road.
Yeah. So I guess the question for investors, as always, is the price I'm paying too high? And during any boom, during any mania, really the saying goes out there, valuations don't matter anymore, right? It's this concept that this is such a revolutionary technology that there's really no price too high that you can pay for that. Now, throughout market history, investors have had to learn the hard way that price indeed matters. You just don't know when it's going to matter, right? So Nvidia is trading at 39 times sales right now for a $1 trillion company. We've never seen anything like that. But we don't know if that's going to go to 50 times sales, 60 times sales right before it goes down. What we know from history is companies that have traded at this high of a multiple in the past have found it very difficult looking out, let's say, the next 5, 10 years to have a high rate of return on their stock. And all you have to do really is go back to Nvidia in the year 2000 to see this play out, where Nvidia had a 90% drawdown after that. It took many, many years before the stock would recover. But here we are again today. And what I would say is that investors just be careful about taking a look backwards and assuming the future is going to be the same. There's no question. Had you invested in Nvidia a year ago, 2 years ago, 10 years ago, you're talking about turning 100,000 into 11 million. These kinds of things are eye popping. They really trigger your emotions, right? We're wired to believe that this type of gain in the future is possible. But think about that now. This is $1 trillion company. If that were to grow at the same rate in the next 10 years, you're talking about a company that's bigger, way bigger than the entire U.S. economy. So keep expectations in check. And what I would tell investors is take a look at how you were feeling with something like Tesla just a few years ago. And as you said, Tesla, great company. Electric vehicles are here to stay. It's going to continue to grow. We know that. The question a few years ago that I posed when I wrote a piece about Tesla was, are investor expectations assuming that only positive things will happen in the future, that there won't be less competition, that margins will stay elevated, and that Tesla will continue to grow at the rate it's growing, right? And what we've seen over the past 2 years here is kind of a reversion to the mean in that valuation, still elevated, but nowhere near that 30 times sales. So the question for NVIDIA is not will it grow? It's going to have enormous growth rates in the next few years. It's really what is that valuation going to be in the future? And it's likely to be lower than today. That's just what history has taught us. So when we look at NVIDIA, and I think this is important, Peter, right? When people think about the best performing stocks, they very rarely talk about the hardship that you would have to go through in order to reap those gains. So yes, you could have turned 100,000 into 11 million. That's assuming that you could have withstood just excruciating drawdowns. And very recently, NVIDIA had an over 60% drawdown. Assuming that it won't have a large drawdown again with the type of volatility it's had this year alone is probably not a good assumption. And so just keep that in mind for these big winners. They all have that same theme. And I just want to go back to Cisco. You probably remember, Cisco, Intel. We could have talked about any number of these stocks from back in 2000. This is really the last time we saw companies, and Cisco was one of the biggest companies. For a brief moment, it was the biggest company back in 2000, trading back then at the exact same price to sales ratio pretty much as NVIDIA today. And if you go back and read the stories about NVIDIA, about Cisco back then and investor expectations, you heard similar things to what you're hearing in terms of NVIDIA today, which is that you can't value this company anymore. The technology is so revolutionary that valuations really have to be thrown out. And what we learned from Cisco basically since then is that it did have a enormous reversion to the mean. Just got crushed, did not hit a new high until the 2021 boom after that 2000 peak. And today, 23 years later, Peter, the stock is actually lower. So valuation did end up mattering for Cisco, but during this period on the run up, it was very hard to predict where that was going to end.
Valuation always matters eventually. That's the part that we can never figure out is when it's going to happen. I do know the times I've been assaulted the most on Twitter, where my commentary on Dogecoin, Tesla at its peak, when I said it was a little too crazy, and then a couple of days ago about NVIDIA. I just think that these valuations matter. They can keep running for the short term. In the long term, the market's going to catch up with all of them. And listen, for a lot of people, the anchor of their portfolio is large cap U.S. stocks. They use the S&P 500 to have that position. And guess what? Big tech is the biggest part of that. So for most of even creative planning clients, for most of them, their biggest positions are Apple and Microsoft and NVIDIA and Tesla and companies like that. So if you look at the run-up that's been happening, it's very largely concentrated in this space. There's plenty of participation without placing a bet that the impossible may continue for the prolonged future.
So what you're saying, and I think it makes a lot of sense, is that if any investors dug into that portfolio that they have, and they have that ETF or mutual fund that is a broad market fund, they're participating by the fact that these are the largest holdings in the U.S. in all of those products. The question is, for those investors, do they want to take another additional bet? And right. We know in the past that would have been a great thing to do in the last 10 years, no question. The question is, going forward, does it make sense at these types of valuations? I think it's becoming more difficult to make that case. But here's a question I'm going to put out to you. I put it out to my Twitter audience. I'm going to ask you the same thing. next 10 years, Peter, what's going to have a higher return, Nvidia or the S&P 500?
Oh, I'm taking the S&P 500 all day long. Better valuations, better expectations. There's always another up and comer, and the S&P 500 will almost certainly have that position. And most stocks underperform the S&P 500. What lifts the S&P 500 above the average stock is that it always catches the next high flyer. Bogle said, quit looking for the needle in the haystack, buy the haystack. And that's basically what this bet is do you want to go look, do you want to assume NVIDIA is the needle in the haystack going forward, or do you want to own the haystack and it could be some other company and you participate?
So it's a high probability bet, similar to the Warren Buffett bet, where if I assume if I asked you this question with any individual company, you'd probably say the S&P 500 because
That's
the
right.
odds
The
are going to be in
valuation
your
just
favor.
makes it easier. But yeah, it doesn't matter what company.
Right. Okay. So last thing on this technology boom, I have to just throw this chart out here because it's surprised me. We had that huge run up in 2020, 2021 in terms of tech outperforming everything. And then we had that huge downturn last year. But this year, with that AI mania, exuberance, whatever you want to call it, we're at new highs in terms of relative strength. You have to go back all the way to 2000 to find the relative strength of the tech sector. So just looking at the performance of tech sector versus the S&P 500, you got to go all the way back to 2000 to see it this high. Does this concern you at all? And what should investors take away from looking at a chart like this?
It actually doesn't concern me. I think that technology as a sector has started to take over a big part of the economy. So it makes sense that it is taking a little bit away from all of the other sectors of the economy that make up the S&P 500. So to me, it's a natural state. I think the different question would be the concentration of so much of that in just 6 or 7 companies. I think that's what's really, really unique, and how Congress is eventually going to deal with that is going to be interesting. But to me, the fact that technology is taking over as a larger percentage of S&P 500 makes perfect sense given where the economy is going, and where it has been for the last 10 years and where it's going.
This is a fundamental rationale. Yeah, and what I would note here is if you went back to 2000 and looked at the S&P 500 and you broke down the tech sector weighting and you looked at the tech sector's contribution to the S&P 500 in terms of revenues or profits back then, it was a massive spread between the two. So the expectations were way ahead of the actual fundamentals. Today, they're ahead of it, but not nearly as much. If you look at the most profitable companies, they are those tech companies. If you look at the S&P 500 as a percentage, break it down by sector, tech is the highest revenue sector, highest net income sector by a wide margin. So our expectations are very high, and maybe if those margins were to come down, we'd see some compression for sure, but not exactly the same situation as back in 2000. So I just come back to the point that we made the last video, that this cycle can go in both directions, and it doesn't have to crash like it did back in 2000, but there could certainly be a period of a decade or longer where tech is no longer the leader. That's why you want to own things other than just tech, because we just don't know the future. So let's move on, talk about big winners. So similar theme to Nvidia, and this is a question I get asked a lot. Well, how do I own the next big winner? I often put out this chart showing the top 30 stocks in the S&P 500 over the last 30 years. Most people wouldn't have guessed number one on the list. Peter, maybe you would have. Monster Beverage. I don't
100%
know.
no. Every time I look at the list, I do a double take. It's hilarious to me that Monster Beverage, a company nobody talks about, is not number one perpetually on this list. Is hilarious.
Yeah, and of course the big reason for that is Monster Beverage is very small back
Yeah.
back then, and so its growth rate was much higher. Obviously, Amazon, you wouldn't have done too badly owning Amazon as well.
Yeah.
I think the other interesting thing about this list, Peter, is people assume that it's going to be all technology companies. Obviously, Monster Beverage clearly showing that it's not. But if you look at companies like Pool Corp or companies like O'Reilly Automotive or Ross Stores or any Tractor Supply, there's a number of different ways, Starbucks obviously on here, that investors have made money in the long run. It isn't just driven by technology. Does that surprise you at all? The American economy pretty diverse, and you just have this contribution from these surprising areas.
I think your point is exactly right. And why I like owning a broad-based index is so many of the future companies, that the companies that have so much growth in the rearview mirror are companies that started out a lot smaller, and they're not in sexy industries. So you put that combination of a company that's got a high growth rate, maybe they've built some kind of moat that protects them against competitors, and they're starting out on the smaller side of the S&P 500. That's why the lists you put out are always littered with these companies. And the anomaly is not those companies. The anomaly is big tech. Historically, you don't see huge companies, double up in 5 years like we've seen recently, which has really skewed the proportion that they make of the S&P 500.
No question. And when people ask that question, how do I own the next big winner? They're always leaning towards building some type of concentrated portfolio because they say, well, I have this diversified portfolio. It's done very well for me, but if only I have had my portfolio concentrated in a few of these companies, of course, I'd be much better off. How do I own them? And there was an interesting study that came out here looking at the shareholder wealth creation over time. So going back, I think they went back to 1928 and looked at the entire equity universe and said, well, what are the percentage of contribution to overall shareholder wealth? And the surprising thing that they found was that a small number of companies contributed a vast majority of that shareholder wealth creation. Apple, of course, being the biggest, Microsoft number 2. You have Exxon on there, Google, Amazon. Probably not surprising the names on this list, but what was surprising, I think, is the concentration in terms of that shareholder wealth, where you saw just 3 firms responsible for 10%, 11 firms 20%, 72 half of the shareholder wealth. And so the natural assumption, I think, for people is, well, why don't I just own those few? They're creating all of the wealth. The problem is we don't know which of those are going to be the leaders. So when someone asks me that question, how do I own the biggest winners? The answer is you simply, as you said, what Bogle said, you own the haystack. And if you own a broad market index fund, a total market ETF or mutual fund, you're owning all of these companies at some point or another, right? When they're public, they're eventually going to come into this index. And I don't know if there's any other way to guarantee it. That's the best way that I know of without taking that additional concentration risk.
I completely agree. And all of this reinforces the idea that if you want the next big winner, you buy the indexes, and you're going to get the next big winner. And it's impossible to go pre-select those few that might pull it out consistently. We know that people that bet on that, even the professionals and their hedge funds and mutual funds, the probability they're going to underperform is very, very high, especially the longer you extend the period of time. 3, 5 years, 10 years, it becomes harder and harder and harder to do it.
No question. And just one other point from that study that was really fascinating and really shows you the odds of a stock picker are really against you. So 58%, what they found is 58% of the companies, of all the companies that have ever been issued in the U.S. stock market, have underperformed during their lifetime just simple treasury bills. So you would have been better off buying short-term treasury bills, essentially cash, as opposed to buying those stocks. Just a remarkable finding that your odds over the long run, in the short run, of course, are going to be massive volatilities and massive big winners, and you could get lucky picking stocks for sure. But in the long run, the odds seem to be against you because most companies aren't around 30 years from now that are around today, and the few winners that are around will do well. But the only way that you're going to ensure owning those is to own everything. So I just thought that was a very important point for people to understand, that the odds when you diversify, you increase your odds of having a positive outcome. When you concentrate, yes, the potential upside is no question greater, but the odds are against you from succeeding because simple math shows that most stocks simply are not at the next Apple or the next Amazon or the next Nvidia.
And this is hard for people to understand because they have embedded in their minds more risk, more reward. And this is an example in investing where it's just not true. If you own the index, you're actually taking less risk and you have a higher probability of more reward. And I think it's just counterintuitive to people. It's tough for them to really get their arms around that.
Diversification, they say, is like the only free lunch that exists where you can
Yep.
have that scenario. Yeah, the high risk, high reward. Every time there's a Silicon Valley bank failure or any bankruptcy, Bed Bath and Beyond, those stocks were extremely risky, right before they went to zero,
Mhm.
and you were not rewarded for that. So that concept, really throw that out the window in terms of picking individual stocks. So let's talk about the next correction, Peter. This is not something the last week or two people are talking about. Markets have been pretty calm of late, but everyone's always worried about the next correction. And we went through a big one last year, obviously over 27%. And there were many reasons people attributed to that. And there's various ways that people try to avoid corrections, right? They jump in or jump out themselves. They can maybe, they might buy treasury bonds. They might buy the volatility products, but many different ways. They're trying to avoid that downside. And that feeling is not, we all have that. We would love to avoid the downside. No one wants to go through these painful declines. And what a lot of people have gravitated to is products that do it for you. So things like tactical funds where they're jumping in and out and for you. And really, they make the case, if you read the literature in these products, that they can participate in the upside but avoid the downside. And that's very compelling. It's a good selling point. And only problem is, if we look back and see how these funds have done, not very good. So this study came out from Morningstar here. They started with 30 something funds in this tactical allocation area. This was 10 years ago. And what they found was not a single one of these funds 10 years later had a higher return or Sharpe ratio than a simple 60-40 portfolio, a balanced fund. You've been much better off just buying a simple balanced fund that did not try to time the markets. I know this isn't surprising to you, but it may be surprising that not a single one got lucky and outperformed.
I write a lot in my books and social media about this, and the reason that these tactical funds, this stock picking, flipping in and out of the market approach is always going to exist, is because people believe that someone can outperform in this space because it's true in every other space, right? Like if you work harder at a sport, you get better at it than other people, and if you work harder as an architect, you get better at it. But you can know everything in the world, and if you're a market timer, the probability you're going to outperform is very, very close to zero over a very long period of time. So there's a lot of people that want to buy the idea because they're in professions where the more you work, the more likely you can figure out something no one else can.
Hmm.
I think the second component is it's the easiest investment approach to sell, right? Like no one wants to hear an advisor that says, "Hey, look, I can't predict the next downturn. I don't know if the market's down 5%, if it will go down 10. I think we should stick with it. Here's your allocation, and here are the investments you should have to cover the short term, long term." I mean, that's boring, right? Now, sophisticated people get it. It's one of those interesting things. Like the more you know, the more likely you are to buy into that, and be wary of people selling tactical. But the reality is, most people don't understand all of this, and so they are more likely to buy someone selling that, which is why it exists now far more than a more disciplined approach, and it will continue to exist forevermore.
Yeah, absolutely. The what comes to mind, I wrote a piece once about when you mentioned the lack of relationship between hard work in the investing field and better outcomes. I wrote a piece once talking about the 10th so-called 10,000 hours rule, right, which
Right.
applies to Malcolm Gladwell popularized it in his book Outliers, and it's a simple concept. You spend 10,000 hours on something, you're going to become an expert, whether it's music or sports or chess. Right? He gave a number of examples, the Beatles being one of them. The problem with the markets is it's not a fixed game. So unlike tennis, where you can keep getting better, the rules are fixed. The market, the rules of the game are constantly changing. No environment, if you had an environment that was favorable to, let's say, an inflationary strategy in the past, well, now you have a different environment. You had an environment that was favorable to swings back and forth, and now you have a steady move higher, right? So the market doesn't reward you doing the exact same thing in the past, which means that it's not repeatable. So even if you had success doing one thing, you can't count on that and going forward. And actually, what we found is and this is crazy for people, as you said, in professions where hard work has gotten to them, sort of doctors, lawyers, right? They've worked hard, they study, the harder they work, the more they learn, the better they are at their profession. Well, in investing, you could work 18 hours a day trying to study the ins and outs of everything, and you could be more active than other people. So it seems like you're doing more. Right? You're going in and out and trying to figure out the markets every dip and every advance. But that actually hurts you more than it helps you. So the bias towards action, towards doing something, which we all want to do. So don't when you see the market going down, well, what are you doing about it? Well, it's doing nothing doesn't sound very good. So doing something we try to do, that's actually counteractive. And I think this was really surprised me a little bit that, but maybe not, maybe it shouldn't have, that had those tactical allocation funds simply held their beginning portfolio 10 years ago and did nothing else. So just had the holdings in that original portfolio, they would have beaten their actual moving in and out. So very counterintuitive for people, but I think an instructive lesson. The markets are not like other areas in life where the harder you work at something, you're going to necessarily be rewarded for that. So just getting the few simple things right, diversification, rebalancing, things like that, could be far more important than trying to figure out every single move up or down, where we can see the professionals themselves can't seem to do it with any type of consistency. And I'll just end here with Peter Lynch, my favorite quote on this, where he's saying far more money has been lost preparing for corrections or trying to anticipate corrections than in corrections themselves. And that's, just put that on your wall if you're watching this, because initially, yeah, you might get out at the right point in time or at one, but you have to also then get back in the future before the market starts going back up, and very few people are able to get that right on both ends. So let's switch gears here, Peter. The power of no. You have a pretty busy schedule. How do you do it? How do you say no to things? I know that has to be part of the process. You and I have tweeted about this. I think it's an important point. Anyone who's really successful, Warren Buffett has talked about this, Steve Jobs, they have to start to learn to say no, maybe not early in their career, but as their career progresses. How do you feel about this concept of saying no? What are things that you say no to today that allow you to do as much as you do in a given day?
Well, what I learned a while ago, many years ago, thankfully, is I would say yes to anything. Like if someone wants to help people, and so need a mentor, yes. Can you spend more time with me on this? Yes. Can you be on this charitable board? Yes. And as my kids started to get a little older, I realized that I might be in a board, really worthy cause, but I'm not with my kids, right? And so you start to realize that a yes to something is a no to something else. And when you start to look at it that way, it becomes a lot easier to say no.
Yeah, no question. You can't, what I tell my kids is you can do anything, but you can't do everything. And your bias should be towards that no. And for me personally, in terms of career stuff and doing media, initially I was bombarded with reporters and these CNBC or other thing, come on and do a segment on this subject, and you say, well, I should always say yes to that. Why wouldn't that be good? But if you're doing all of that, you don't have any bandwidth, any time to create things yourself, to create value, to do things that are longer term in thinking. And so learning to say no to those things opens up just a lot of different opportunities. And for me, it's been a powerful lesson. Not easy to do, but learning to do it has made all the difference for me. And really, it comes down to saying no allows you to say yes to the things that really matter. And that's true in personal relationships, anything. It's just a limited bandwidth. You can't have 1,000 friends. You can't have 1,000 relationships. You have to, at some point, say no to things. And I think that's anybody can use that to try to focus on the things that matter. Okay, signal or noise. This is we'll cover this briefly. The debt default, we covered it probably too much the last time, but I think pretty much you and I were on the same page. Ignore it, and here we are. They made their deal as expected a few days before the so-called deadline. They suspended the limit. They actually suspended until January 2020. 2025, so after the election. And we have sovereign CDS spreads that everybody was trying to scare people with, saying, "Look at all these people buying default insurance. This has to be an indication of something wrong." And then right away we have this deal, and the CDS spreads come back down. So not much to say here, Peter, other than the next time, January 2025, when this happens again, just understand, right, that it's noise.
I
And
mean, I agree. It's nice you're starting with one that we were right about.
good. Well, we'll pat ourselves on the back. And this
Yeah.
is just illustrating the last few months, right, has all been about the debt ceiling and S&P just rallying in the face of that, right? Looking ahead, obviously, they knew there was going to be a resolution. And as you said, there was a little bump up from the stock market. But now going forward, who knows, right? The market will react to other things. But now we have 23% rally off of the October lows last year, and the debt ceiling really inconsequential for the market. So Alan Greenspan, just briefly, I love this quote. And if anyone ever asks me, well, why can't the U.S. default? Well, Greenspan put it best. We have the power of the printing press. So if we ever were in the situation where we're going to default, no, we'll just print more money and so and pay it back. That has a lot of problems, obviously. People are not going to lend us more money, but we could immediately tomorrow, if we wanted to, print 30 trillion in new money and pay everyone back. We're not going to do that, but that's always a possibility. So keep that in mind as well. So we're going to end with the VIX, and the VIX is something a lot of people talk about. And today, the VIX is getting back to levels before the pandemic, February 2020. Low VIX. There's some people would say that this is evidence of complacency. How do you look at the VIX when people talk about volatility? Does it ever get your attention in terms of being a signal?
I think volatility, as measured by the VIX, is, to me, always noise, except when it's extremely volatile. When it really goes off the charts, it really can be an indicator of something to come. So, all the volatility we're seeing now, how little, how much, the fluctuations we had over the last few months, not enough to be indicative of anything, all noise.
Yeah, so the historical average for the VIX, just for viewers, 20. It's around 20 historically, and we see this mean reversion above it, below it. We always end up coming back to it at one point or another. So with that the VIX is going to go back to that kind of average level over time, but you don't know what the markets are going to do. And the only way I look at it is in terms of extreme. When the VIX is really high, it's another way of saying there's a lot of fear in the market. You can kind of quantify this. So I looked at the top 10% of VIX levels. So last year we saw a number of these above 28.6 historically. Data goes back to 1990. What have we seen for forward S&P 500 returns? When you're at these high levels of VIX, you actually tend to see above average rates of returns over the next 1 to 5 years. So if there's panic in the markets, it's usually opportunity. This is nowhere near 100%. So you can have a high VIX and the market can still go down, certainly in the short run. But usually, more often than not, the market recovers and actually has a better return. And if we look at the most extreme, so in the last, looking at the financial crisis or 2020, we had just unbelievably high levels of VIX. So these are the highest weekly closing levels for that volatility index. And what you'll notice here, a lot of green and a lot of high returns going forward. And these were the absolute worst times, quote unquote, for investors. And they actually, in actuality, were the best times for investors looking forward. So when there's a lot of fear and you're hearing the VIX is the highest level since the financial crisis or 2020, if you have a little extra cash that you're not going to need, that's probably not the worst time to put a little bit more money to work.
Agreed. I think any time that there's fear, and the VIX is a great indication of that in general, over the long run, you're going to win more than you lose, which means you'll win.
No question. All right, Peter, covered a lot of ground there. Thanks, everyone, again, for joining us. For more content, subscribe to the channel. And Peter and I will see you next time, episode 5 of Signal or Noise. Thanks again.